Good afternoon and welcome to our webinar. I'm Kim Williams, Financial Planner at Creston Reeves. There is no doubt that this year has been tough and challenging for all of us. It has meant that we focused on what is most important to us, our health and our loved ones. Many of us have had to consider our personal or our family's financial security and know that it's vitally important that we have a plan, one that enables us to fulfill what we want to do now and one that can accommodate turbulent times. With the help of my colleagues, Solicitor Sarah Manouche and Partner and Head of Tax Daniel Grange, this webinar is aimed at encouraging you to reflect on your personal financial circumstances and create a simple personal finance action list. Excuse me. There will be a Q&A session at the end of the webinar, which gives you the opportunity to submit any questions you may have. And we will be joined by a range of expert panelists who will be pleased to answer these. On our panel, we have Creston Reeves Partner and Head of Legal, Philip Lansbury, Chartered Financial Planner, Terry Burgum from Creston Reeves Financial Planning, Chartered Financial Planner and Society of Later Life Advisor Lee Hayward, also from Creston Reeves Financial Planning, and our Tax Director Joe White. You can ask a question by typing and submitting in the panel on the right-hand side of your screen. We will be circulating a feedback survey and a copy of today's slides following this webinar. Your feedback is important, so please complete and return this to us. You can, of course, speak to your usual contact at Creston Reeves with any specific questions you may have, and you're welcome to contact the presenters directly. Our individual contact details can be found on your respective slides. We'll be using a fictional but fairly typical case study comprising of John, who is a successful business owner and is now looking to retire. His wife, Fiona, is a couple of years younger than John, but wishes to retire at the same time as when he sells his business. They have 2 children and 2 young grandchildren. They also own a rental property. We will also make reference to the national survey we undertook to better understand individuals' aspirations and actions taken to plan ahead for their future. I'm going to be starting the webinar today looking at taking benefits from pensions. The first step to planning is to understand what you're trying to achieve in terms of your goals and objectives. Our recent national survey findings suggest that John and Fiona's 3 highest priorities for retirement are likely to be travelling, spending time and treating their family, be it their children, their 2 grandchildren, Peter and Rebecca. Your financial planner will take the time to get to know you and understand your goals. Like the highest percentage of respondents from our survey, both John and Fiona intend to fund their retirement by using state pension, personal company pensions and their savings. Given the results of this survey, I intend to focus on using pensions as a retirement planning tool, but other assets should be considered in reality. For example, John and Fiona are generating additional income through their rental property, just like another high percentage of our survey respondents. One type of pension is known as a defined benefit or final salary. This scheme gives you guaranteed, usually inflation-linked pension for the rest of your lifetime. Another form is a defined contribution or an investment-linked pension. This scheme offers no guarantees and the income generated depends on the performance of the underlying investment strategy. When you come to draw your benefits, there are 2 common approaches and I wanted to talk through the pros and cons of each of these. So this is for your investment-linked pension. So you've got an option of having flexi access drawdown. So this works like an investment portfolio, but as it's inside a pension tax wrapper, 25% of the fund is free from tax and 75% of it is taxed under PAYE. You can draw any amount from this arrangement from 0 to 100% of the fund, although the tax consequences of drawing that 100% should be considered. Because of this, there is more opportunity to plan your income and amend this to suit your needs. It offers the potential for future capital growth and inheritance tax or succession planning. As this type of arrangement is free from inheritance tax, many of our clients defer drawing down on their pensions, if that's affordable to them, and use them as an inheritance tax planning tool. You still have the opportunity to purchase an annuity in the future should you wish to do so. There are disadvantages, of course, to flexi access drawdown. So will the income that you choose to withdraw be sustainable? In other words, if you draw down too much, you could run out of money. The fund values would change with stock market movements, and annuity rates could fall in the future if you decide to purchase one at a later date. Another option is to purchase an annuity. This is where you usually draw down 25% of the fund value tax-free and pass the remaining capital value to an insurance company who will offer you a secure income for the rest of your lifetime. This provides a guaranteed level of income so you won't run out of money. You can provide an annuity income to your spouse too. Quite simply, you know what you're going to get, for example, tax-free cash and taxable income. You can spend the tax-free cash as you wish or invest it to generate further retirement income. The advantages to an annuity is that the income is fixed from outset and it cannot be changed as your financial position changes. You are dependent on annuity rates and your health at the time of securing the annuity. There is no possibility of future investment growth like you would get with your flexi access drawdown. It will usually cease on death. That really depends on how it was set up, but there may be no dependents pension. This graph illustrates what we call the retirement smile. An annuity purchase is less common in recent years due to the changing income needs of our clients, and this will explain why. When we initially retire, we're young, healthy, and tend to enjoy traveling whilst we're able to. From our mid-70s, our spending needs change as we become less mobile and get a little bit older. Then much later in life, our income needs may increase as we may need care at home or even move into a care home. The flexi access drawdown option allows you to adapt your income to your changing expenditure requirements, whereas an annuity purchase is usually fixed at outset. One question I'm frequently asked is how much do I need to save into pensions to fund my desired retirement? This slide illustrates an example of annuity purchase so you can get a feel for how much you should be saving to meet your goal. I've used a fund value of just over £1 million, which is the lifetime allowance limit, and I'll come on to the lifetime allowance in more detail later. The earliest age you can access your pension is 55 under current pension rules, but I've assumed that John wants to retire at age 65. So he makes a withdrawal of 25% of the value, and that's his tax-free cash, so around about 268,000. He then purchases an annuity with the remaining amount, which gives him 37,000 a year before the deduction of income tax. Given that bank interest is low at the moment and his mortgage has been repaid, he's keen to know what his options are in terms of the tax-free cash amount, so the 268,000. We decide to invest this for him, which generates a further around about 13,000 a year, taking his total gross annual income to just over 50,000. There are many different ways to generate retirement income from your assets, and we don't have time to cover all of these today, but this example is designed to give you some consideration to the level of savings that you need to achieve a decent level of income in retirement. The 50,000 figure that I've used there, that's only 4.7% of the starting value. So with people living longer, it can be a scary thought to consider how much needs to be saved to have a comfortable retirement. What I've done here is I've looked at nine steps to retirement planning. So we normally say that during the 5 years prior to your retirement date, you should seek professional advice. And this is why it's important. So what the investment risk is the first point. So what if you plan to retire on the 1st of April 2020? The graph here shows the performance of a typical portfolio over the year to the 1st of April 2020. Now, during the middle of February, you would have thought that investments were rising, which was excellent timing with your pending retirement. Then at the end of February comes and COVID-19 hits us. So if an investor had planned to retire, then their investment or pension portfolio could have seen a fall of 16% in this example, which may delay your retirement plans, or it may mean that you need to spend less in your retirement. Some more steps here. So lifestyling. So workplace pensions have a set default retirement date. Lifestyling is a strategy within a pension plan, and you must have it within a workplace pension. So make sure that your pension has the correct intended retirement date for you. For example, you may have a pension plan that has a date selected on at age 65, but you want to retire at age 62. So it's just worth making sure that that age 65 is changed to age 62. You need to have a plan. So are you using drawdown or an annuity purchase? Your investment strategy should be constructed depending on what type of income requirement you need in the lead up to your retirement. Affordability, review your expenditure. Can you afford to retire? Are there any items of expenditure which will increase or decrease once you stop working? Your life expectancy, how long do you think you're going to live, and how long are your assets going to last for? Your savings, do you need to boost your savings to meet your goals? What about your state pension? Are you on target to receive the full amount of the state pension? All your other assets, have you considered income generation from all your assets or just from pensions? Tax allowances, are you using all of your tax allowances to help reduce your outgoings, and will this continue throughout your retired years? HMRC pension protection, do you foresee a lifetime allowance problem either now or in the future? So these are all individual questions. There's no right or wrong answers here. They're just points, some steps that we need you to think about when you're planning your retirement and distributing that wealth. We use cash flow forecasting tools that can help answer most of these questions. So the lifetime allowance I've mentioned a couple of times. So that's the maximum value that you can hold within a pension without paying any lifetime allowance tax. So it's another form of tax. As I mentioned before, the lifetime allowance at the moment is just over $1,073,000. So any savings above this level are going to be charged to tax of up to 55%. There's sometimes a misconception that this tax needs to be paid on a pension fund when the value reaches this figure. So you might be lucky enough to be 53 and have £1 million in your pension. That's fine because you can't draw the money out when you're 53. But the key point here is to make sure that you plan for it. So the lifetime allowance is only tested when you come to draw your benefits, when you die, and on your 75th birthday. There are other points when this will be tested, but they're the most common ones. All of your pensions other than the state pension are tested against this lifetime allowance. So John has a final salary pension and a defined contribution pension. They will both be tested against this. The value of these pensions for HMRC purposes is $1,115,000. This is because the pension from the defined benefit pension, the $5,000 a year, is multiplied by 20. You then add on your lump sum, so add on the 15,000, and then add that to all your other pensions. So it can accumulate fairly quickly. The excess over the standard lifetime allowance is $41,900, and that could be charged a tax of up to 55%, so $23,000. A possible solution is that you might qualify for some protection from HMRC. There are two types of protection available at the moment, which is individual protection and fixed protection, 2016. You have to meet certain criteria to qualify for these protection. So individual protection, you'll qualify if the value of your pensions on the 5th of April 2016 was more than £1 million. Fixed protection is available if you haven't paid into pensions since April 2016. If you don't meet this criteria, then the standard lifetime allowance will apply to you. Tax-free cash is only available on savings up to your lifetime allowance as well. So the standard lifetime allowance, going back to the slide that I showed you earlier, is £1,073,000. Tax-free cash is therefore around about £268,000. So if your pension value is 1.5 million, you will still be capped at 268,000 if you've got the standard lifetime allowance. Divorce could impact on your lifetime allowance position. So we would always suggest that you seek professional advice if your pensions are subject to any pension sharing order. Our survey showed that 30% of those over age 60 have never taken financial advice. Pensions are a complex area, and once you stop working, you'll want your savings to work hard for you. You can do this with the help of a good financial planner who will prepare you for retirement, formulate a plan to meet your retirement income planning goals, manage your investments to suit your views and objectives, and regularly review your income and capital requirements. As I said earlier, we use cash flow forecasting tools. So if you're thinking of distributing wealth and giving some money away to your children, family, then these tools can make sure that you will retain enough capital and income for the rest of your lifetime. Thank you very much. I will now pass you over to Sarah, who's in our legal team.
Thank you very much, Kim, for those insights. I'd like to thank you all once again for attending our webinars. These come off the back of our Planning for the Future report, which is a report which sets out the results of a survey in which over 1,000 people were asked for their views on investments, tax and future planning. So if you haven't downloaded the report yet, I believe you can do so on our website, or we can send you a copy. It really does make for an interesting read, and it captures a unique snapshot of people's views in these unprecedented times. I'm a solicitor and Director of Legal Services at Creston Reeves. I've been in practice for over 15 years, working with private clients, dealing with wills, probate and trust. I'm pleased to be talking alongside my colleagues today. I came to work in-house at Creston Reeves because I'm passionate about providing a holistic approach for clients and working alongside our financial planning advisors, tax team and other professionals to give clients the solutions they need. In this webinar, I'll be picking up on some of the legal steps that distributors can take to plan for their future. I'm going to be looking at some care fees planning, business trusts and wills, and finally some generation skipping in deeds of variation. I addressed in my earlier webinar today the steps that accumulators may wish to take to secure their future. Now, John and Fiona in our case study are in their 60s and in the distributors category, so their priorities are likely to have changed. At this age and in their circumstances, there are potentially two areas that they might be thinking about. Our survey indicated that 39% of those over 60 have still not considered long-term care fees planning. So John and Fiona should be taking advice on this issue from our financial and other advisors, but also on how this can be managed and planned for in their wills. In addition, John now has a successful company, and I'm sure his thoughts will turn to business succession, tax planning, management buyouts, etc. These should be considered overall, but also in terms of will drafting. So moving on. So how can care fees planning be addressed in a person's will? Well, the most common scenario that we see with wills is where one spouse passes away, leaving everything to the surviving spouse. The survivor then goes into care and all of their combined assets can be attacked for care fees purposes. Now, John and Fiona have a significant estate. Later on, I think you'll see we've estimated it to be around 4 million. And therefore, care fees planning may not necessarily be that relevant to them. However, for couples with a combined estate of perhaps under 1 million, 1.2 million, care fees can significantly reduce that, and they may wish to consider how this can be managed. So moving on. One of the most common arrangements used in wills for care fees planning is a life interest trust. Now these have lots of different names. Sometimes they're called a right to occupy, right of residence, an interest in possession trust, an immediate post-death interest. There are lots of different names for them just to confuse everyone. There are some minor differences between them, but for the purposes of this webinar, I'm just going to call them a life interest trust. In order for this arrangement to work, if John and Fiona own their property jointly, they'll need to ensure that their joint ownership is as tenants in common rather than joint tenants. Ownership as tenants in common means their respective shares in the jointly owned property pass under their will and not automatically to the surviving joint owner. Now, this is a change that can be made by using a solicitor to submit a form to the land registry. It has no real other implications other than how those shares devolve on death. So if there are mortgages or charges on the property, you don't usually need permission from them to do this. Now, people often stop at the tenants in common point. I get asked by people to convert their property to tenants in common for share fees mitigation. But crucially, this is just the first step to ensuring that arrangements would work. In addition to that, John's will would create a trust of his share of the property. Now, this trust would allow Fiona to live in his share until her death, or if John wants, he could terminate that right to reside on her remarriage or cohabitation. Fiona would now have no capital interest in that share of the property. Her right is merely to live there. And then on her death, John's will says that his share passes to his children. Likewise, if there's a rental property and that's owned by John solely or jointly with Fiona, then John could do something similar with that in his will. He could provide for a trust of his share and say that Fiona's only entitled to receive the income, i.e. the rents, rather than any capital interest. So moving on. So what would be the impact on Fiona if he passes away and she goes into care? Well, she still has her own share of the joint properties to fund her care needs. She may also receive some cash, some other assets outright from John, and be receiving an income from the rental property. But crucially, John's capital share of the matrimonial home and the rental property is unlikely to be included in her assessment for care fees. We usually fall outside of that assessment, so that could be really useful for care fees mitigation. There are also some other benefits to life interest trust arrangements. So, for example, if Fiona remarries after John's death, then the trust would come to an end and his children would take his share of the properties under his will. Whereas if he'd left everything to Fiona and she remarried, he'd be relying on her to leave assets to his children under her will. And for inheritance tax purposes, these trusts, albeit they only give a right to income or a right to occupy for the spouse, they're still treated as spouse exempt. So if you're concerned about care fees, then do come and take some advice on these types of trust arrangements. They're now really common. In fact, I tend to do these more than just your ordinary leaving everything to a spouse outright. So moving on to business trusts in wills. Like many in his age bracket, John is planning on selling his business. Dan Grange, partner and head of tax, will be talking after my webinar about lifetime arrangements that he might want to put in place for tax planning purposes. But what if something happens to John before then? It's likely that John's shares in the company would benefit from business property relief from inheritance tax. This relief is available so that businesses don't go under on the owner's death because of an inheritance tax liability. And it's very valuable and important to make good use of it if John passes away. His will needs to incorporate tax planning arrangements to do this. It's essential that someone qualified to advise on these complex tax arrangements advisors on his will. Our survey showed that 74% of people in the distributors category have used a solicitor, and that's with good reason. In general terms, if business property relief applies, you should be leaving those assets to what we call a chargeable beneficiary, i.e. someone who isn't ordinarily exempt, like a spouse or a charity. So a chargeable beneficiary would be children, or if they're not old enough, perhaps you'd look at a flexible arrangement like a trust, particularly a discretionary trust. So moving on to the next slides, where I set out an example of how these arrangements can work. So John passes away, leaving his business worth 2.5 million and other assets of 1.5 million. And he leaves everything to Fiona. Now, there's not going to be any inheritance tax at that stage because Fiona's a spouse and the transfer will therefore be spouse exempt. But Fiona doesn't know how to run the business and has no interest in it. So she sells it a year later for 2.5 million. And in doing so, she trades assets which have qualified for business property relief for cash. Cash doesn't get any inheritance tax relief. So when she dies 5 years after that, and her estate is calculated for inheritance tax at 4 million, her children are going to be paying a whopping 1.3 million in inheritance tax. So moving on to the next slide, which is example 2, where we're using trusts to utilise that business property relief. So the same scenario, John passes away leaving his company, 2.5 million, other assets 1.5 million. He leaves his business assets into a discretionary trust and everything else to Fiona. And his will appoints trustees who have the expertise to run the company on his demise. At that stage, there's no IHT to pay because the transfer to Fiona is spouse exempt, and the business assets will get 100% BPR. His discretionary trustees can continue to run the company. They pay dividends to Fiona during her lifetime to maintain her. 5 years after her husband passes away, Fiona dies as well, and her estate for calculating inheritance tax is 1.5 million. Her children will pay 200,000 in inheritance tax. After her death, the trustees of the discretionary trust direct dividends to the grandchildren for their education, and eventually they sell the company after John's death and distribute to his children. Now, I've put an asterisk next to that final point to remind me to say that there are taxes payable on this type of trust. Income tax, capital gains tax and inheritance tax are applicable to these types of trusts, but with careful planning and advice from us and our tax advisors, maybe less overall. For example, maximum rate of inheritance tax in this trust is payable at 6% every 10 years on exits from that trust, which is significantly less than the 40% rate payable on death. And if the assets still qualify for business property relief, they may avoid that 6% as well. In addition, the discretionary trust can be run for 125 years. So if assets continue to be held within the trust, they avoid being taxed every time they pass through a person's estate. So I hope that's given any business owners some food for thought. And moving on to what else John and Fiona should be considering. Well, they should really be looking at lasting powers of attorney. These are documents in which they can appoint someone or someones to deal with their health and welfare and property and financial affairs if they can't make decisions for themselves. So, for example, if they suffer a crisis event. So moving on, our survey confirms that a whopping 68% of distributors do not have lasting powers of attorney, which is unforgivable. As we get older, the likelihood of a loss of capacity is far greater, so they really must consider putting these documents in place now, appointing people to deal with things if they can't. If you've lost capacity, you can't put in place a lasting power of attorney. You need to understand it in order to put one in place. So instead, their family would need to apply to the Court of Protection for a deputyship order. That comes at a greater cost and a greater level of scrutiny. With John running a business, he should be looking at putting in place LPAs as part of his crisis management and disaster planning. Who's going to run the company if John has an emergency and is unable to deal with decisions himself? Who can access the business account to pay wages and trading costs? And moving on, there's also a particular risk if John is the sole shareholder and director of his company. If something happens to him, either on death or a crisis event where he loses his capacity, then only shareholders have the right to appoint a new director. And as he was the only shareholder, a stalemate arises. Recent case law confirms this isn't easy to resolve and might need an application to the court. So to avoid that situation, he should be looking at his will, potentially amending company articles, and putting in place an LPA so that someone can step into his shoes as a shareholder. Now, there's a branch of property and financial affairs LPAs that means that we can do specific LPAs to cover just a business or business decisions. John may find it helpful to have someone different, someone who's perhaps more familiar with the business, such as a manager, etc., in that attorney role. So perhaps not even Fiona in that instance. Okay, moving on. As mentioned previously, LPAs also cover health and welfare decisions such as diet, medical treatment and life-sustaining treatment. If COVID has done one thing, it's to highlight that we never know what's around the corner, so don't leave these things to chance. Okay, so what other points should distributors be considering? Well, you can see from our case study that John had elderly parents who've now passed away. And he may have received an inheritance from them, perhaps one that he doesn't really want, he doesn't need. He should be talking to them, he should be talking about a deed of variation in that instance to redirect any inheritance that he doesn't want, perhaps to his children or grandchildren. Now, you may have heard of a deed of variation associated with David Cameron, who used one of those, but they're not just something that Prime Ministers can use. They're available to anyone who is due to receive an inheritance and doesn't want it and wants to pass it on to someone else. They're a really tax efficient way of generation skipping. We draft them regularly when dealing with probates. So if you're due to receive an inheritance, definitely take advice, and we can also help on the probate process as well. Okay, so moving on. If you have a business, in summary, points that a distributor should be considering. If you have a business, you really should have a business LPA, and distributors are at an age where they really must consider doing health and welfare LPAs and property and financial affairs LPAs as well. They should be thinking about generation skipping with inheritances and using deeds of variation to redirect unwanted inheritances. So if you are due to receive an inheritance and don't want it and don't need it, take advice, but you must do that quickly as there are time limits. And finally, if you don't have a will at this point in time, you really should. So get one done. Take advice from qualified professionals who can help you achieve your aims and maximise the inheritance tax reliefs that are available to you. If you do have a will, review it regularly. Wills are documents that will evolve and change over time to recognise your priorities and needs, not something you should put in a drawer and forget about. Here at Creston Reeves, we're unique in that we can offer you comprehensive advice on all aspects of your future planning. So get in touch and take advantage of our support. I'd like to thank you very much for listening to me today, and I look forward to answering any questions later. And I'm now going to pass over to Daniel Grange, Head of Tax and Partner at Creston Reeves. Thank you very much.
Thank you, Sarah. Good afternoon, everybody. As Sarah said, my name is Daniel Grange and I'm Head of Tax at Creston Reeves. This afternoon, I'm going to talk to you about the results from the tax-related questions from the distributors in our survey and some tax planning opportunities for you to think about. I will be using the same case study of John and Fiona that Sarah and Kim have talked about to illustrate some of our points. So some of the key findings from our survey were that 21% of the distributors own all or part of a business, and this compares to 49% of accumulators, suggesting that a number of people have already exited their business by the time they reach the age of 60, which is where our cutoff was. For those people who are business owners, 29% did not have a succession plan in place. And this was quite a surprise to us because this was higher than the accumulator group. And in general, we would expect those over 60 to be thinking about their succession plans and retirement. And we'd recommend that business owners always have an eye to the future and ensure that they are well prepared. For those who said they did have a succession plan in place, succession by family members was the most anticipated route compared to a management buyout for accumulators. I'm not going to talk about how an exit might be structured, but I think it's worth noting there are unique challenges and considerations when involving family members in a succession, as it's not a wholly commercial decision, so it does bring in different things to be considered. 44% of our distributors did not know their potential inheritance tax liability. We tend to find that clients younger than their mid-50s generally are not too concerned about inheritance tax planning, but I'm surprised that the number of people in the older category were not aware of their potential inheritance tax exposure. And as I'll talk about later, there are things to be thinking about. Before moving on to capital taxes, it's worth thinking about income, and this has already been touched on by Kim, and ensuring that you are using your allowances and thresholds as effectively as possible. And that's particularly where we're talking about a married couple and assets can be transferred between them tax-free. We'd recommend you think about who holds those income generating assets to make sure that you use those tax thresholds and allowances. So the tax-free personal allowance, the tax-free dividend allowance, which is £2,000 per person, and think about tax thresholds. So high rate tax kicks in at 50,000, you start losing your personal allowance at 100,000, and you start paying the additional rate of tax at 150,000. So think about who's receiving income and at what tax band they're paying tax. And also think about gift aid donations and who's making those, because you get tax relief on those, and make sure that those are being made by the person paying tax at the highest rate. So thinking about John, and as we heard earlier, he's a owner of a company and he's looking to retire. So thinking about what happens on a sale of his business. So as a high rate taxpayer, John will generally pay 20% capital gains tax on anything except for residential property, and 28% on gains relating to residential property. If you qualify for business asset disposal relief, that used to be known as entrepreneurs relief, then there's a 10% rate of tax on qualifying disposals. And there are conditions to be satisfied to qualify for this regarding the type of asset, the length of ownership, and also what the business is doing. So it must be trading and not an investment activity. The lifetime allowance for entrepreneurs relief is £1 million per individual, and that's down from a previous limit of 10 million. So we saw in Sarah's example that John was the sole shareholder in the company, so he'll only have £1 million of gain that's taxed at 10%. If instead he transferred some of his shares to Fiona and she owned those shares for at least 2 years before sale, then potentially she can qualify as well, and that could save up to £100,000 of capital gains tax. And as I mentioned earlier, if John and Fiona are taking dividends out of the company, we'd really want to make best use of their allowances and thresholds as well to minimise their overall tax liability. I'm sure you will have read in the press about potential changes to capital gains tax and the recommendations from the Office for Tax Simplification regarding or suggesting wide-ranging changes to capital gains tax. My view, and I have no hotline to Rishi Sunak or the Treasury, is that this is the wrong time in the economic cycle to make significant tax changes, particularly capital gains tax, but we will have to wait and see. I suppose an observation here is that unless a sale is imminent, triggering tax now with the hope of saving tax in the future is probably not appropriate, but it really does depend on personal circumstances. Sarah's already touched on business property relief, and I'll talk about this more later. But where you have assets that qualify for business property relief, there are tax planning opportunities before a transaction to move value to future generations or other people more effectively than is possible after a sale. So really do think about what your capital and income needs are following a sale, and whether there is the opportunity to move value to future generations before the transaction takes place. If business asset disposal relief is available on the whole gain, you may well want to secure this rather than long-term potential tax savings. But if the gain exceeds that limit, this is certainly well worth thinking about. So thinking about inheritance tax on business assets as the next topic, as we know, 21% of our distributors own all or part of a business. Sorry, could we move on to the next slide? Thank you. And there are some specific inheritance tax considerations for those people, and Sarah's touched on those slightly. There's 100% relief from inheritance tax on qualifying business assets, which include shares in an unquoted trading company, interests in a trading partnership, and a sole trade business. And there's also 50% relief for assets that you own personally, but are used by a trading company that you control. So this is an incredibly valuable relief. Although business is in the name of the relief, you really need to think about it as trading property relief. It's not available on investment businesses, for example, property letting. Sarah's talked about the use of trusts to secure business property relief on death, and that's really important. The other thing that's important is that business property relief is removed where there's a binding contract for sale. So if we move on to an example, this shows what happened to the combined inheritance tax liability of John and Fiona from before a sale of their business to what happens after a sale. So John's business is worth, say, 2.5 million, and that qualifies for 100% business property relief. So there is inheritance tax on their combined estates of £340,000. Once the business is sold, that's converted to cash, and after paying capital gains tax of £400,000, the inheritance tax liability has increased to 1.18 million, so an £840,000 increase. So it's just to be aware that as soon as you sign that contract to sell your business, as well as having capital gains tax to think about, there's a big shift in your potential inheritance tax exposure. So now thinking about some inheritance tax planning ideas, our survey said that 44% of distributors don't know their inheritance tax liability. And based on the data that we do have, even those who say they do know their liability were inaccurate in estimating it. So it's really important to understand your potential inheritance tax exposure. If you don't know that, you don't know whether it's appropriate to take any action or not. So I'm going to talk briefly about 3 possible inheritance tax planning opportunities: lifetime gifts, family investment companies, and just reiterating a point Kim made earlier about pension funds. So any inheritance tax planning that you undertake really does need to take account of your current, future income and capital needs. And as Kim said, we can help you with that in terms of that cash flow modelling and forecasting to see what your needs are and what the impact would be of transferring assets to others. So the first inheritance tax planning opportunity is a lifetime gifts, and considering either outright gifts or the use of a trust. So an outright gift is the simplest form of inheritance tax. There's no upfront charge, and if you live for 7 years, there's no inheritance tax payable on that gift. But you're giving away control, and you've given away flexibility because you've given it to one person and then it's theirs for life and theirs to choose what they want to do with. And if it's a gift other than cash, there's potentially capital gains tax to pay as well. Alternatively, you could think about setting up a trust. There's a limit to how much value you can transfer into a trust without an upfront tax cost, and that's normally £325,000. But it does allow you to prevent an upfront capital gains tax charge. It also allows you to retain control because you can be the trustees of the trust, and it gives you flexibility so different beneficiaries can benefit over time. For example, grandchildren if they're going to school, or if they're going to university, or you want to pay school fees and things. So some pros and cons there of different routes. The next thing to think about is a family investment company. And this is really suitable, particularly in John's situation, if he sold his business and he has a pot of cash and he's looking how to invest that. A company can offer a really tax efficient way to hold investments from an income and capital gains tax perspective. And by understanding the difference between or different rights that shares in a company can have, you can flex where the different rights sit. So voting rights, entitlement to dividends, and entitlement to assets in the event of a sale or winding up of the company. And this family investment company structure, where the older generation owns some shares and they perhaps and perhaps some shares are owned by children or grandchildren or a trust, can allow you to transfer value but allow retention of control in a really tax efficient way. And that's partly due to the way that shares are valued in companies. So, for example, if you have a 25% shareholding in a company, the value of those shares will not be 25% of the value of the whole company. There's something called a minority interest discount that applies, and that can significantly reduce the value that is subject to inheritance tax, both in each individual's hands, but across the family as a whole. So I haven't got time to go into those in huge detail, but they are a really interesting structure that can be used to provide a long-term investment structure that can be passed down the generations really tax efficiently. And finally, I just wanted to reiterate a point that Kim made in terms of pensions. Pensions are an incredibly tax efficient vehicle, both in terms of contributions that go in and receive tax relief, growing income and capital gains tax free, and being exempt from inheritance tax. So if you don't need the money that is in your pension, leaving it in there is a really good tax planning opportunity. And instead of withdrawing income from your pension, drawing on capital from other assets may well be a tax efficient route to follow. And following pension changes a few years ago, you can now leave your remaining pensioned pot, if you're in a defined contribution scheme, to future generations. And depending on how old you are when you die, that can pass tax free. So leaving money in those pensions can be a really tax efficient move. So to summarise, the actions that we would recommend for our distributors are to review the use of your tax allowances and thresholds, make sure that's as efficient as possible and you're paying as little income and capital gains tax as you possibly can. If you're a business owner, plan for an exit, look ahead. Some of the planning requires at least 2 years to be in place to minimise the tax as much as possible. Make sure you understand what your potential inheritance tax liability is, and with that knowledge you can make an informed decision about what steps, if any, you want to take. And finally, if you do have an inheritance tax liability, consider those inheritance tax planning options that are available to you, all the time making sure that you will have sufficient income and capital to fund your lifestyle that you would like to keep. That's it from me. I'm going to hand back to Kim, who is going to run through or to share the questions that have come in from the audience.
Thank you, Dan. Yes, so this now brings us to our Q&A section, where we'll have a range of panelists available to answer your questions. There they all are, smiley faces. Thank you to all of you who've already submitted questions. To those of you that haven't, there's still a chance to do so, and all questions will remain anonymous. So let me bring up a question. So Terry, are you ready?
I'm ready.
You're ready? Okay. At these times of very low interest rates, what do you think about premium bonds?
Well, that's a good question. So premium bonds, of course, have many advantages. So they're a very safe place to put your money. It's backed by the government and it's very accessible. So it's a good choice, potentially, if you need that money in the short term or don't wish to take any investment risk with that money. However, there are no guaranteed returns. You are entered into a prize draw once a month. The value of that prize fund is 1% of the overall amount of money invested in premium bonds. So effectively, if you've got an average return, you'd get 1% a year. But of course, there's no guarantee of that, and you may end up getting nothing if your numbers aren't pulled out of the bag. With odds of 34,500 to 1, you've got to be quite fortunate to get a regular prize. But of course, the risk-reward question. So, what are you giving up? If you're just otherwise going to stick the money under the bed or put it in a low-yielding deposit account, you might be prepared to take that risk because you could win up to £1 million as a prize. Alternatively, if you're prepared to invest the money longer term, you may get a more reliable return through other forms of investment.
Thanks, Terry. I've got another question here. It's probably going to be answered best by maybe Philip Lansbury and Lee Hayward. So the question is, my wife and I have individual £200,000 life policies which we want to remove from our estates to ensure no inheritance tax is paid on either amount. We appreciate that IHT is payable, that no IHT, sorry, is payable between husband and wife, but they want to make sure that their children receive the proceeds on death. So what's the best way to achieve this? The insurance company refuses to give it any help. So Lee, do you have any comments on that?
Yeah, happy to go first on that one. Phil, if you want to add in at the end, by all means, please do. So yes, it's relatively straightforward to place a life assurance policy into trust, either at the point you're setting it up or if it's been in place for some time. There's no value to the policy until death, so there's no issues as far as inheritance tax is concerned on placing the policy into trust, generally speaking. The life company is probably shying away from just providing advice or any guidance verbally over the telephone. They will usually have trust forms and maybe some guidance notes on their website that you can download and complete, but you may obviously want some assistance with that. If the trust form doesn't really suit your needs, then you might want something a little bit more bespoke, and that's where the likes of Sarah and Phil can come in and draft something up that's a little bit more bespoke to your requirements. But a simple trust form will require you as the settler to place the policy into trust. You nominate your trustees. In the example we've got there, it may well be that the trustees are the spouse and the children, because the interested parties then have control of the money in the event of death. There are advantages. The policy proceeds will be outside of the estate in the event of a death claim. They're usually paid quickly, so there's no need to wait for probate, and the trustees obviously have control over what the funds are used for. So it should be a relatively straightforward thing to do. Did you want to add anything, Phil?
No, that was a brilliant answer. I suppose I will add on there that I read that they're individual policies, so it seems that each of the couple have got their own individual policy. So if we are to assume that if one of them dies, the £100,000 or whatever it is paid out at that stage, was the intention originally that it should go to the surviving spouse so that they literally pick up 100,000 cash to use in later life, or and so on? Was that one's got to look at the plan and make sure that when you're doing your tax planning, the tax tail's not wagging the dog, so that you don't change the whole purpose for which you took the policies out to try and avoid some tax. I'm not suggesting you don't avoid tax for a second, but just be mindful of why you did it, why you thought you needed that amount of money when one of you died, and whether in fact that's changed. Because if it has changed, you could use a trust and park the money up there to avoid the inheritance tax. But if it hasn't changed, then you probably don't want to trust because you're planning to spend the money on something.
Thank you, Phil. I've got a question here for Joe. I've got more income than I need. Is there a way that I can give this away tax efficiently?
In short, yes. There is a inheritance tax exemption called regular gift out of income. that you can set up, and any gifts that you make don't fall within the normal 7-year rule. And those gifts that you make on that regular basis can be any sum and reviewed on a regular basis as well, so it can be changed over the course of time. The key point is that it's out of income and you can identify that. So you need to do a cash flow income and expenditure account each year to be able to identify that that is surplus income to your requirements. And that will include things like holidays and sort of other costs that you normally factor in. It's also really important to have documentation in place from the beginning, because if you don't put that documentation in place and then die suddenly, in theory, the regular gifts can still be applied, even though you've only maybe made 1 or 2.
Thank you, Jo. I've got a question here. Does the lifetime allowance include rental received from commercial property in a SIP? I can answer that. The very, very simple answer is yes, it will. So the rental income that's generated by the asset within the SIP will count towards growth for the lifetime allowance purpose. Philip, I've got another question for you. Are old style EPAs still considered better than LPAs?
I don't think they've ever been considered better than LPAs. Let's just examine it a bit better than that. They're still valid, okay? So if you've got one, it will do the thing that it was ever intended to do. The reason they were replaced by lasting powers of attorney is that so many problems were created by enduring powers of attorney, which eventually the government decided to do something about. So that's why we now have lasting powers of attorney. They are a better means of organising the giving of a legal authority to someone else to look after things for you. And we not only have now a financial version of the EPA called the Property and Affairs Lasting Power of Attorney, which is the mirror, if you like, of the old EPA. We also have a health and welfare version of powers of attorney. So the government recognised that people in later life suddenly started to value how they were looked after, who looked after them, who decided which nursing home they went to, and whether their leg was cut off or not by the doctors. They wanted all of this to be, you know, put down an illegal means so that people can take charge of these situations and anything else that might come up as well. So everyone, no doubt, should have a health power of attorney. It is absolutely vital. You are more important than your money. Okay, let's put that there. All right, nothing is more important than your health and your standard of living and your care. Is it? Can anyone argue against that? But don't forget the money is important. It is, obviously, but the health one is a must, and so is the financial one. If you've got an EPA, should you replace it is a question we're often asked. Should I just scrap it and get one of the new versions? It's a very debatable question there. I don't think there's a clear-cut answer, really. The big advantage of the new powers of attorney is that if somebody becomes unwell, so something is needed quickly, you know, because there's been some sort of tragedy, somebody's had a stroke or something and everyone's panicking. Right, you've got a lasting power of attorney, you can use it immediately, right there and then. With an enduring power of attorney, you can't. And you have to go through a registration process with the Office of the Public Guardian. Now that's a lot of paperwork, a bit of expense, but worst of all, it's 8 to 10 weeks delay. And if there's a crisis and financials are needed to be accessed, then your power of attorney is not going to be your get out of jail card, because you can't use it in the event of one of those crises occurring. So the lasting power of attorney was invented partly to stop that problem. So that is the big advantage of the new form of power of attorney. But leaving that aside, they both do the same thing.
Thank you, Phil. There are lots of other questions coming in, so thank you very much for those. I'm conscious of the time and other commitments that you've probably got, so I just want to say thank you very much for joining us. We will respond to your questions in due course, but obviously our contact details are on screen, so do make contact with us as well if you've got any questions. You'll shortly be receiving a message asking for feedback, and we'd really appreciate you completing that. I hope that you found the webinar useful, and do contact us if we can help you. Have a good day.